Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at NIO.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So, getting right into it today.
Yeah, and I want you to picture something for a second. Picture a furnace, right?
Okay.
For years, you've just been, shoveling billions of dollars into this massive, roaring furnace just to keep it from going out.
Sounds stressful.
Right. And everyone looking from the outside, they tell you, you're completely crazy. Like, Wall Street analysts are just mocking the cash burn.
Yeah, they love to do that.
They really do. But that has been the harsh reality of building a modern electric vehicle empire entirely from scratch. You have to build the gigafactories, right?
Right, and secure the supply chains.
Exactly. The lithium supply chains, hire armies of engineers, and you're doing all of this before a single car even rolls off the assembly line.
It's in a massive capital sink.
It really is.
Yeah.
And for the longest time, that was the entire narrative weighing this company down. It was just the ultimate, cash burn story.
Yeah.
And this is what we're looking at today. What happens on the exact day that furnace finally starts generating more energy than it consumes?
That's the million-dollar question. Or, well, billion-dollar question.
Exactly. Because we're looking at a fresh stack of data right now that suggests this company just crossed one of the absolute hardest thresholds in modern business.
Right.
So the mission today is to really figure out if this is the exact moment that the narrative permanently flips, going from this terrifying cash burn story into a wealth-building, profitable growth machine for your portfolio.
Yeah, and the numbers coming out of their facilities right now, I mean, they're basically forcing the entire market to rethink that old narrative.
They really are.
Because, when you want to understand the wealth-building potential of any automotive stock, you have to look under the hood at its fundamental engine. And right now, that engine is just running at a record pace. Like, if we look at the first quarter of 2026, deliveries exploded.
Yeah, what were the exact numbers on that?
They hit nearly 83,500 vehicles.
Wow.
Yeah. And to put that kind of volume into perspective, they have essentially doubled their output from the exact same period last year.
That's almost 100% year-over-year increase.
It's a 98.3% increase, to be exact. And the momentum is just accelerating as we get closer to the present.
Right.
Like, look at March 2026 alone. That month accounted for over 35,400 of those deliveries.
Which is just huge.
It's a massive 136% surge compared to the prior year.
The sheer scale of those delivery numbers is wild.
Mm-hmm.
But I want to stop and look at the underlying mechanics here for a second.
Okay, sure.
Because a lot of times in the EV sector, companies will just slash their prices to pump up their delivery numbers.
Oh, yeah. We see that all the time.
Right. They want to make the quarterly report look good, so they push metal out the door, but they absolutely destroy their balance sheet in the process.
Yeah. A race to the bottom.
Exactly. But that is not what is happening here. And that's what's so crucial. This volume is actually yielding margin expansion.
Which is rare.
Super rare. Vehicle gross margins hit an incredibly healthy 14.7% in late 2025.
Wow, almost 15%.
Yeah, and overall, gross profit jumped 51% year over year, which brings us to the ultimate milestone here.
The profitability report.
Yes, the late March 2026 reports show the company achieving its first ever quarterly profit.
I mean, that milestone, it's really the holy grail for institutional investors, right?
Totally.
It represents this fundamental inflection point.
Yeah, I look at this entirely through like a bricking gravity analogy.
Okay, how so?
Well, for years, the whole growth at all costs phase was like a rocket, right? It's burning massive amounts of fuel just to fight gravity and get out of the atmosphere.
Right.
The cash burn was the fuel. But hitting this first ever profit means they've finally reached orbit.
Ah, I see.
The engines just don't have to work as hard to keep the whole operation aloft anymore.
That makes perfect sense.
But I do have to push back on the enthusiasm for just a second.
Fair enough.
Because does this profitability milestone definitively kill the old Wall Street fears of constant cash burn and, shareholder dilution?
That's a really valid concern to bring up.
Because for a long time, the cynical view was that every time the stock rallied, management would just use it as an excuse to issue more shares, raise capital, and dilute everyone holding the stock.
Right. But to understand why that threat is evaporating now, we have to look at the actual mechanics of how they achieve that positive earnings before interest and taxes.
The EBIT.
Exactly, the EBIT. Because reaching profitability in auto manufacturing, it isn't just a stroke of luck, It's not a clever accounting trick.
Right, you can't fake it.
No, it is entirely a function of scale. And the linchpin in this new data is that they recently surpassed the 1 million cumulative delivery mark.
1 million.
Yep. In March, they officially hit 1,881,000 units. And when a manufacturer reaches that specific kind of scale, the whole financial physics of the company changes.
Because of fixed costs.
Exactly. You finally start amortizing your fixed costs effectively.
So break that down for the listener. What does amortizing fixed costs actually look like, on the factory floor?
Okay, so think about the gigafactory itself.
Okay.
You've got the robotics, the massive stamping machines, the huge overhead required just to keep the lights on and the lines moving.
Right. It's incredibly expensive.
Very. And those are fixed costs. They cost the exact same amount of money whether you're producing 10,000 cars or 100,000 cars.
Wow, yeah.
So when you're only building a few cars, the cost of that factory per vehicle is just astronomical.
And that's your cash burn.
Exactly. But when you spread the cost of that same factory over 1 million cars, the burden per vehicle plummets.
Right. It just drops off a cliff.
Yeah. The factory costs the same to run, but now it's producing exponentially more revenue. And that operational leverage, we really started seeing it become highly visible back in the third quarter of 2025.
What happened then?
Revenue rose almost 17% to roughly 21.8 billion RMB.
So the millionth car is vastly more profitable than the 10,000th car.
It's a totally different financial profile.
That's incredible.
It is. And when you combine that operational leverage with those 14.7% vehicle gross margins, you transition from bleeding cash to generating sustainable free cash flow.
Which changes everything for the stock.
It does. Once a company proves it can fund its own operations internally just through the cash flow, it generates the threat of shareholder dilution just plummets.
Wall Street can finally stop modeling for constant capital raises.
Exactly. And they start modeling for actual earnings per share growth.
Okay, so if this scale is protecting their margins today, I guess the next question is how they protect that advantage tomorrow.
Right.
Especially in a sector that is famous for brutal price wars. How are they maintaining this hyper growth while keeping those margins intact?
Because everyone else seems to be slashing prices just to survive.
Exactly. I mean, it looks like their primary structural moat is the battery as a service model, right? And that broader power charging infrastructure.
Yeah, the battery as a service or base architecture, it is arguably the most fascinating structural advantage in the entire EV landscape right now.
Explain how that works for someone who might not be familiar.
So instead of buying the car and the battery as one massive, expensive unit, the consumer buys the car itself, and they simply subscribe to the battery.
Right, I've always thought of this like the old razor and blades model.
Yeah, that's one way to look at it.
But honestly, that analogy feels a bit outdated for something this complex. It's really more like cloud computing for physical transportation.
Oh, I like that comparison.
Right, because before Amazon Web Services, a tech startup had to buy $1 million physical server rack.
Which was a huge barrier to entry.
Exactly. Now they just rent the compute power they need. And this company is basically doing that with lithium-ion batteries.
Yeah.
You buy the hardware of the car, but you subscribe to the energy platform.
And that dramatically lowers the upfront cost of the vehicle.
Which makes it way more attractive to the buyer.
Exactly. But more importantly for your portfolio, it creates massive switching costs.
Right. If you're plugged into this battery swapping ecosystem, you aren't going to suddenly jump ship to another brand.
No, you're locked in. And the proof is really in the product adoption. Like the redesigned ES8 is a massive hit.
What are the numbers on that?
We're talking 80,000 deliveries in just 181 days.
Wow.
Yeah, it held the top spot for large SUVs in China for 3 consecutive months.
That's serious market dominance.
It is, and what makes that strategy so brilliant is how they're structuring their actual brands to protect those premium margins while still grabbing market share.
Okay, how are they doing that?
Well, the premium flagship brand is now supported by 2 new subsidiary brands.
Right, ONVO and FIREFLY.
Exactly.
I see the logic there. It mirrors how legacy auto operates, right? You have your luxury tier, your mid-tier, and your entry-level tier.
Precisely. It creates a highly resilient ecosystem. FIREFLY, in particular, is really what's driving their international expansion into Europe right now.
Which is a huge market.
Oh, massive. And by diversifying their product mix across different price points and geographic regions, they fundamentally reduce their reliance on the premium domestic consumer.
Right, so if the premium market softens slightly due to, like, economic headwinds?
The volume from ONVO and FIREFLY can step in, It keeps the factories humming and ensures those fixed costs stay amortized.
Okay, let me stop you right there, though, because the competition is not just sitting still while they build this ecosystem.
No, definitely not.
I'm looking at the numbers from their rivals, and the density of competition is just fierce right now.
It's a crowded market.
XPeng has posted 268% growth in some recent periods. Li Auto delivered over 41,000 cars just in March alone.
Those are monster numbers.
They really are. So if Li Auto is pushing out 41,000 units in a single month, is a battery swap mode truly enough to insulate them from a pure price war?
It's a fair question.
Like, are consumers really that loyal to a battery subscription when the guy next door is offering a massive, $10,000 discount on a traditional EV?
That is the main bear argument for the sector, right?
Right.
And it's a completely valid concern.
Yeah.
However, you have to look at the psychological and practical utility that the battery swap ecosystem offers. Pure price cuts simply cannot match it.
How so?
First, it completely eliminates battery degradation anxiety.
Oh, right. Because an EV battery is the most expensive component of the car.
Exactly. If it degrades over 5 years, the resale value of your car just plummets.
Nobody wants to buy a used smartphone with a dead battery, let alone a used car.
Right. But with battery as a service, you're always swapping into a healthy battery. The company assumes the degradation risk, not the consumer.
That is a massive psychological relief. The switching costs aren't just financial then, they're lifestyle conveniences.
Exactly. And consider the physical reality of the charging experience, too.
Okay.
Swapping a battery in one of their robotic stations takes roughly 3 to 5 minutes.
Which is basically the same as pumping gas.
Right. Whereas fast charging a traditional EV, especially in cold weather, it still takes significantly longer.
Yet, sitting at a charger for 40 minutes is not ideal.
Not at all. So for consumers who live in high-density urban areas without dedicated home charging, or people who just frequently drive long distances, that convenience is worth a significant premium.
So while XPeng and Li Auto are fighting this brutal margin-eroding price war to win over the purely price-sensitive buyer,
The battery as a service model locks in a completely different kind of consumer.
it effectively insulates them from the race to the bottom.
Exactly.
Okay, so they have a structural moat protecting the hardware. But there is another layer to this narrative that I think is fundamentally changing how Wall Street views the company.
The tech angle.
Right, and it has nothing to do with bending metal. It's the shift from being valued as a traditional auto manufacturer to being valued as a technology and AI platform.
This is where the long-term wealth-building potential really gets supercharged for investors.
Yeah.
Because if you scan the financial news right now, like outlets like Benzinga, for example, the sentiment is just overwhelmingly bullish.
It is.
And a major catalyst driving that sentiment shift was CEO William Lai's recent sit-down with Qualcomm China.
Yeah, the rhetoric coming out of that meeting was incredibly strategic. They're actively shifting the narrative to position the car not just as a mode of transportation, but as the, quote, core engine pushing AI forward.
Exactly.
But help me bridge that gap here. How does a car function as an AI engine?
Well, think about a modern EV. It's essentially a supercomputer on wheels.
Right.
It's equipped with LiDAR, cameras, all these spatial sensors. And they are gathering millions of data points every single second about the physical world.
Mapping roads, analyzing driver habits.
Yes, and optimizing battery efficiency in real time. But to process all of that data instantaneously, which is what we call edge computing, you need incredibly powerful silicon.
And that is where a partnership with a giant like Qualcomm comes in.
Exactly. Qualcomm provides the processing brains, so the car becomes this localized node in a massive AI network, constantly learning and updating over the air.
Okay, but why does Wall Street care so deeply about that distinction?
Well,
Like, why does it matter to your portfolio if the market calls them a car company versus a tech platform?
because it all comes down to how institutional allocators assign value.
Okay.
Traditional automakers assemble metal, right? They have massive physical supply chains, union constraints, and historically low single-digit profit margins.
Right, it's a tough, low-margin business.
It is. And because of that structural ceiling, the market usually assigns them a very low price-to-earnings multiple.
Like, what, 5 to 8 times their earnings?
Yeah, exactly, around 5 to 8 times. But technology and AI platforms, on the other hand, are built on recurring software revenue.
High margins, infinite scalability.
Right. And the market happily assigns them multiples of 20, 30, or even 40 times earnings.
Wow. So if the market stops viewing them as just an assembly line and starts pricing them as an AI platform,
It looks like a complete re-rating of the stock's underlying value.
what does it actually look like in practical terms for the stock price?
Well, if the company proves that its software, autonomous driving capabilities, and AI integrations are the true profit drivers, the stock price doesn't just go up because earnings go up.
Right.
The stock price goes up because the multiplier the market applies to those earnings expands exponentially.
Oh, wow.
Yeah, that is how you capture explosive wealth generation.
Because you're getting double leverage,
Yeah,
the earnings are growing, and the multiple applied to those earnings is growing.
precisely. Furthermore, when you are viewed as a tech leader, you attract a completely different class of institutional money.
Right. Which brings us to the actual plumbing of the stock market.
Yes.
I saw some speculative, unconfirmed catalysts floating around about potential inclusion in domestic Chinese indices, specifically the Hang Seng Tech Index.
Yeah, and while that does remain unconfirmed, you really have to understand how index inclusion forces liquidity into a stock.
Right. It triggers mandatory buying.
Exactly. Every single passive ETF and mutual fund that tracks the Hang Seng Tech Index would be structurally forced to buy the stock just to match the index weighting.
Completely, regardless of the current price or market sentiment.
Exactly. It is blind, automated buying pressure.
Add to that the potential for increased mainland Hong Kong Stock Connect inflows as this profitability trend solidifies.
Which is a huge factor.
Right, because the Stock Connect allows mainland Chinese investors to easily buy shares listed in Hong Kong.
Right.
If the local retail and institutional base decides this is their domestic AI champion, that opens up a massive pipeline of fresh capital.
Definitely. All of this creates a really powerful undercurrent of structural demand. You have tech-focused funds reallocating, passive index funds potentially being forced to buy, and mainland capital flowing across the border.
Okay, so we have the fundamental thesis, the profitability, and the scale.
Right.
We have the narrative, shift, the AI and tech multiple expansion.
Yep.
Now we have to translate all of that into what the stock is actually doing on the charts right now.
The technicals.
Right, because the price action over the last few weeks has been pretty explosive.
Oh, it really has. The technical picture has shifted decisively, moving from a long period of bearish consolidation into a confirmed bullish breakout.
Right, I'm looking at the chart. Shares cleared a major psychological resistance level at the March 31 close of $5.51.
Exactly. And then they surged over 9% intraday on April 1st on incredibly heavy volume.
And a 9% intraday move on that kind of volume that isn't just retail day traders clicking buttons in their brokerage apps,
No, not at all.
That is big institutional money moving in and taking large positions.
Absolutely. Heavy volume on a breakout like that almost always suggests algorithmic buying programs and institutional accumulation.
Because the quants program their algorithms to trigger buy orders the moment overhead supply is exhausted.
Exactly. Once a key resistance level breaks, the algorithms just take over. And this surge didn't happen in a vacuum either.
Right.
Back on March 13th, HSBC upgraded the stock from a hold to a buy.
Which is a massive validation.
It is. That upgrade was crucial because it helped establish a solid support floor in the $5 to $5.50 range.
Because institutional allocators often wait for that kind of analyst validation from a major bank before they start building massive position.
Right. So you have a defined floor, a fundamental catalyst with the first ever quarterly profit, and a technical breakout basically clearing the runway.
I mean, I love the setup, but we have to be completely objective here.
Always.
Stocks do not move in straight lines. And there are real, heavy macro risks that could derail this entire thesis.
For sure.
I'm looking at the broader economic environment, and there's a fascinating contradiction playing out.
What do you mean?
Well, on one hand, the company benefits heavily from the global secular transition away from fossil fuels, right?
Right.
But on the other hand, spiking energy costs and persistent inflation are absolutely crushing the average consumer's wallet across the board.
It's a real squeeze.
It is. The broader consumer discretionary sector is under heavy pressure globally. So can their premium brand really stay resilient when discretionary spending is under attack everywhere else?
I mean, it is undoubtedly the most significant macro risk to the thesis right now.
Yeah.
High energy costs and inflation generally dampen all consumer spending. It acts like a tax on the economy.
Right.
However, you have to remember that the premium EV consumer base is historically much more insulated from day-to-day inflationary pressures than the entry-level consumer.
Oh, that's a good point.
Yeah. If a buyer is in the market for a top-tier luxury SUV, a spike in grocery prices or a hike in local electricity rates might annoy them, but it rarely forces them to cancel the vehicle purchase outright.
I hear you on the premium buyer resilience, but what if the macro environment gets so bad that even the upper middle class has to pull back?
Well, that is precisely why the multi-brand strategy is so perfectly timed. It
Right.
acts as a defensive hedge.
Ah, the ONVO and FIREFLY brands.
Exactly. If the macro environment really does force consumers to trade down, they don't have to leave the ecosystem entirely.
Right. They can simply buy an ONVO or a FIREFLY instead of the premium flagship model.
Right. The company retains the customer, keeps them in the battery-as-a-service subscription loop, and continues to amortize those factory costs.
That's a huge safety net.
It is. And institutional volume driving this April breakout tells us that, for now at least, the smart money believes the battery swap moat and the new profitability metrics outweigh those broader macro headwinds.
They're positioning for a sustained long-term turnaround.
Exactly.
Okay, so let's bring this all together. What is the overarching investment thesis, and what is the actionable takeaway for you, the listener, managing your own portfolio?
Right. Let's break it down.
When I look at all these dynamics, the scale, the AI narrative, the technical breakout, I'm giving this setup an 8 out of 10 bullish score.
I'd agree with that.
Because the company has fundamentally de-risked its profile by proving it can turn a profit while maintaining nearly 100% volume growth.
Yeah. The wealth building strategy here is really setting up as a swing trade, specifically targeting the upcoming Q1 earnings in late May or early June.
Because the entire market is going to be hyper-focused on that specific report.
Exactly. They want ultimate undeniable confirmation of those first ever quarterly profit margins.
Right. If the company delivers a beat on that 14.7% vehicle gross margin, confirming the scale is permanent, we could see a massive re-rating of the stock.
But the action plan here requires patience.
Yes. You don't necessarily want to chase a 9% intraday surge right at the top.
No, that's how you get burned.
Exactly. The smarter strategy is to look for minor, healthy pullbacks to that $5.56 range.
You want to test that floor established by the HSBC upgrade?
Right. Use that to establish or add to a position before the massive earnings catalyst hits in the summer.
Let the technicals work in your favor while the fundamentals catch up to the new AI narrative.
Exactly. Well, I want to leave you with one final provocative thought to mull over as you watch this stock. We've talked extensively about the battery-as-a-service mode today. We've talked about the expansion into Europe with the FIREFLY brand. And we've talked about the AI integration turning these cars into edge computing supercomputers.
Right.
But what if this overarching narrative isn't just about selling their own cars?
Okay, where are you going with this?
If their battery swapping infrastructure is truly superior and they continue expanding those robotic stations globally, could that physical network eventually become the universal licensed standard for other automakers?
Oh, wow.
Imagine a world where legacy car companies realize it is billions of dollars cheaper to simply license this existing swap technology than to attempt to build their own fast-charging networks from scratch.
That would change everything.
It wouldn't just be an evolution of an automaker. That would be turning their biggest historical capital expense into the greatest recurring software and infrastructure revenue stream the automotive industry's ever seen.
Right.
Think about what kind of multiple Wall Street would assign to that.